Welcome back. Earnings season kicks off this week, and while the street expects growth year over year, big headwinds like labor costs and inflation still remain. Supply chain constraints also in focus. In fact, mentions of the word supply chain on second quarter earnings calls more than doubled from a year ago, according to Bank of America Global Research. Let's bring in Savita Subramanian, Bank of America Securities, head of U.S. equity and quantitative strategy. Savita, great to see you as always. Let's start about the level of optimism in general that people have going into this earnings season. We have seen estimates come down. Does that make it easier to beat those estimates?
Yeah, estimates have come down a bit, Wilf, and you're right. I think that does set the stage for, kind of a lower bar to beat. I don't think we're going to see the kinds of beats that we've seen over the last few quarters. I think folks that have gotten used to these, kind of record level, 20% earnings beats are going to be disappointed. In fact, I think that we're going to see a quarter where earnings essentially meet expectations at best, and guidance is probably likely to be more downward than upward. So, I think that when we look at all of the sort of the stage setting that Q2 and analysts have led up to heading into the third quarter, I think we're at a point where I'm not super optimistic about, kind of blockbuster results that we've seen over the last few quarters. And I think the areas of risk are really around supply chain. So here's what I worry about is that when you look at all of the companies that, as you mentioned, in the second quarter, we heard this sort of huge kind of revelation of supply chain disruption in all sorts of areas: consumer, industrials, transports, tech. And those companies, we just looked at where they're trading today versus their historical average multiple. They're trading a full standard deviation expensive. So, this is an environment where these companies are trading at sort of unsustainable levels of kind of positive optimism. And I think that's where we were.
So supply chain issues clearly have been well telegraphed, though. You just think that they're not sufficiently.
So I think that the market and investors are fairly sanguine. I mean, I think what's surprising to me is that margins are forecast to reach brand new record highs by the end of next year. But when you look at the data, when you look at wages, when you look at the costs of raw materials, when you look at even oil prices, I mean, maybe they don't stay at these super high levels for the next 12 to 24 months, but they've moved up a step function. And I think it's really hard to argue you're going to see this, continued margin expansion, continued globalization and gains for tech and for all of these companies as we've gotten to a point where the market is priced for perfection. I mean, when you look at valuations, okay, so Wilf, I'll tell you that the one thing that gives me real pause when it comes to the S&P 500 is when I look at sort of a longer term forecast framework, what we found is that valuations may not determine what happens over the next year or two, but they're sort of all that matters for the next 10 years. Like the current valuation of the market would explain, over 80% of the returns variability over the next 10 years. Our valuation framework right now is spitting out flat returns for the next 10 years. I mean, this is a different environment than we've been in the past. And I think what sort of concerns me is that we're in an environment where analysts are sort of extrapolating from the great trend in earnings that we've seen over the last few quarters, but all of a sudden we're starting to see a lot of hiccups and more kind of friction than just positive pricing power.